You're seeing oil lower, the metals lower, and that is translating through to commodity-tied stocks like Freeport-McMoRan, which of course operates in the metal space. It's down 4.6%. There are some earnings stories out there as well, including Philips, which of course is the Dutch medical devices maker. It reported earnings in the European hours this morning, basically warning of persistent supply chain challenges and said inflationary pressure may stick around for years. A big miss for that company. It's down 11.5% as a result. But on the more optimistic side, yes, dealing with inflationary pressures, but passing those costs on to their consumers through price hikes. Coca-Cola beating on the top and bottom line, revenue up, organic revenue up 18% in the quarter. That stock up about 2.6% at the open, John.
Kelly, thank you. About a minute and 25 seconds into this session, here's one to watch. Twitter up by about 4% in early trading. We are trading in the 50s and getting closer to that offer price of Elon Musk of $54.20. Something has changed over the last week. Let's get to Ed Ludlow on the West Coast for more. Ed, what changed?
Yeah, it's interesting. What changed, according to sources, is that Twitter's board started to take this offer more seriously when Elon Musk disclosed that he had the financial commitments from Morgan Stanley, Bank of America, Barclays, MUFG, a whole list of other banks who were providing $25.5 billion in debt financing. But you look at Tesla, we're down 2.4% Tesla. Sources tell us that the missing piece here is that Elon Musk continues to line up equity partners. So there's $25.5 billion of debt committed, and then Elon Musk himself is committing $21 billion of equity financing. But if he does not find equity partners, one option is for him to sell some of his Tesla shares to fund a part of that equation, which I thought was interesting. According to sources, this is the final stretch, John. We could have a deal announced as soon as today. The board worked into the early hours of this morning with Musk's advisors. There's reporting from what happened over the weekend. In fact, it's kind of a replica of what we saw from the Easter Passover weekend when Elon Musk had his advisors and bankers working that Saturday night into Sunday morning so that we had something for the following Monday, very much playing out in a similar way here. But as with all deals, John, and we say it time and again, sources are warning us it could go on, could stretch out, and could be called off altogether.
Ed, what are you hearing about how complicated the financing and the backing is for this particular bid?
Complicated in the sense that Musk was speaking to different types of equity partners, a wide range according to sources, family offices, high net worth individuals. Then there's the role of private equity, right? We know that Thoma Bravo was coming in. We know that Apollo was coming in. And interesting, in the case of Apollo, sources told us that they could back a Musk bid, but they could also go to Twitter and help them ward off this kind of takeover attempt. I think you're, listening to Dan Ives, for example, Wedbush, some of the other street analysts, what did not happen was a white knight did not come in, right? And so now Elon Musk has options, but the board does seem amenable because of that debt financing that Musk was able to secure.
At another company you report on, Tesla, it is trading lower by about 2.5%. No drama here, not a massive move, but have we got a clear read on what it could mean for that company?
Yeah, there's lots of split opinion on this, right? Why is Musk doing this in the first place with Twitter? Is he distracted from leadership at Tesla? I thought it was very telling on the Tesla earnings call that Musk did not speak first. Zach Kirkhorn, the CFO, did. Drew Baglino, who's the SVP for energy and drivetrain products, took a lot of ownership on the call. So there's a company there where other lieutenants are getting involved. Musk spends a lot of time on Twitter. He has done for years. He's spending a lot of time, my sources tell me, at SpaceX. This is status quo for him, right? And this is just his latest endeavor.
Hey, Ed. Thank you, buddy. Ed Ludlow on the West Coast. You mentioned Dan Ives. This is the view from Wedbush and Dan Ives. The Twitter board could not find a white knight. The clock has essentially struck midnight for the board, which is why negotiations are underway to get a deal done. Dan Ives joins us right now. Dan, do you believe this deal closes today, and why?
I think a deal gets done in the next 24 hours. But because ultimately, as Ed talked about, the financing, once they laid it out, that really put feet to the fire from a board's perspective. And they ultimately needed a white knight, a second bidder to come in. Probably books went around. Private equity basically just couldn't get there. So that's why from a board's perspective, they had to come to negotiation with Musk, a Game of Thrones, and ultimately it looks like the next 24 hours Musk will on Twitter.
Dan, have you got a decent idea of what the plan is?
Look, I think, as this goes private, the first thing was turn to a subscription model. Monetize it. They'll lose a significant amount of subs of probably a $2-3 a month type subscription model. That would increase revenues, cash flow. So I think from a model perspective, that's something that happens right off the board. Of course, getting rid of the bots, cleaning up the platform, potentially combining with some other initiatives, some other acquisitions. I think that's ultimately the goal here, because it comes down to freedom of speech is one thing. He's betting 20% of his net worth on Twitter. So I think that ultimately, now the strategy really needs to be outlaid.
What are the benefits of being private, Dan? Everything you said that they're going to do, what do they need to go private to do that they can't do as a public company?
Well, it's a great question. They could do it behind the scenes. Every quarter, they don't have to answer shareholders. I think that's really the difficult part when you go through a transition like this from a quarterly perspective. And I think that's why they would take it private. Ultimately, maybe over the next few years, come back out, and, it could always go public down the road. But look, I think it just came down to the board was looking for a second bidder. They thought a second bidder would come. It never came. Fiduciary, they had to sit down, and now Musk, it looks like it's in a course, I'd say the last stage to get this deal done.
Dan, you mentioned that they'll push and lean heavily on a subscription model. How do you think advertisers will react to this?
I think there'll be clear pushback. And I think ultimately right now, this becomes a lightning rod on both sides of the aisle, in terms of how this ultimately is going to sort of as a platform. And for Musk, there's political risk in terms of for Tesla, for SpaceX. I think that's why you're seeing that react accordingly in terms of shares. Ultimately, the equity financing that Ed talked about, I think that's something that he just got $25 billion of stock from a target that they reached. So I think that's a big issue. But no doubt, I mean, what you're essentially doing here in the eyes of many, you're trading caviar for a New York City hot dog in terms of Tesla for Twitter shares. And it's a head scratcher, but ultimately it looks like probably by the end of the day, this deal gets done.
Dan, you just said something really interesting. You think this invites risk, regulatory risk, for the likes of Tesla and other Elon Musk ventures because of what he might do with Twitter. Can you just build that out a little bit more?
Look, at the end of the day, from a Tesla shareholder perspective, this is not what you want to see. There's no benefit for Tesla or SpaceX, but it invites, both in the Beltway as well as Brussels, more of that polarized view, right? Some view Musk as a hero, others view him as a villain. It just increases that sort of, I think, noise at a time that Tesla investors don't want to see it. So let's just be clear. That's what Tesla sells off here. As a Tesla investor, buying Twitter, that's not what you want to see. But it is what it is. Musk is going to get it. There is no second bidder. And now it's really just a matter of, I think, timing and, sort of dotting the I's, crossing the T's to get this done.
Dan, just on key man risk, Jay Pawlowski of TW joined us in the last hour, and he said he doesn't see it at Tesla. I know a lot of people who do. Where do you stand on that, Dan?
I think Musk's sole focus, at least over the next year or two, I mean, Tesla's a major focus. We've seen it with the Giga build-outs, of course, with Cybertruck and, some of the issues they have to navigate in China. But balancing a lot of balls here, right? I mean, if you look at the situation with SpaceX now with Twitter, he wouldn't be CEO of Twitter, probably a chairman role. But no doubt, there's going to be a bright spotlight here. That's also why Musk, likely another comp package to make sure he stays on as CEO and chairman, no issues for the next 5 years. But look, it just adds more uncertainty. And just look, go back the last 2 weeks. I mean, the street viewed it was a 10%, maybe 5% chance this deal gets done. Now it's probably upper 90s.
Dan, got to wrap things up with earnings season. What a big week for big tech. We've had a 3-week losing streak on the Nasdaq 100. We're down for a 4th straight session. On the month, we're down by, let's call it 10% now. Dan, the worst month going back to 2008. Microsoft this week. We've got the likes of Amazon over the next week, Apple, Facebook, Alphabet. Take your pick, Dan. How important is this week?
I think it's the most important week for tech earnings probably in the last 7-8 years because of the white knuckles, because of the Netflix debacle. You need to see strength on enterprise. You need to see strength on cloud. And of course, from a productized perspective with a name like Apple. So it's a fork in the road week. I believe ultimately bullish and it leads tech higher. But no doubt, I mean, John, I think it's the most important week that we've seen in tech in many, many years in terms of earnings season.
Tell me the names you expect to see strength on relative to the weakness that the market is priced for and the names that you think we will see that weakness realized.
Yeah, so bullishness, I think significantly better in the street would be Microsoft on the cloud story. I think Apple is another one. I think Google in terms of cloud strength that we're seeing on GCP. In terms of negatives, it's Meta, Facebook, because fundamentally, I think that's the business model has changed there. that's catching a falling knife. So I think it's a bifurcation. And I also think cybersecurity is the pocket that's going to continue to be strong along with cloud.
Dan, just awesome to catch up. Big week ahead. Hopefully we catch up again soon. Dan Ives there of Wedbush, with the Nasdaq down about 0.5%, the S&P down 0.75%. Coming up, Senator Warren urging Democrats to get inflation under control.
I think we're going to be in real trouble if we don't get up and deliver. Then I believe that Democrats are going to lose.
That conversation up next.
I think we're going to be in real trouble if we don't get up and deliver. Then I believe that Democrats are going to lose. Democrats win when they work on behalf of working people.
Senator Warren delivering a warning to Democrats to get inflation under control. Secretary Yellen saying prices are nearing a top.
We want to do everything that we can to lower inflation, and the president has announced an unprecedented release of oil from the Strategic Petroleum Reserve that is serving to hold down oil prices. I think gas prices peaked and have now come down some from their peak.
Team coverage starts right now with Anne-Marie Hordern joining us in D.C., Michael McKee here in New York. Anne-Marie, the message from Senator Warren, pretty clear.
Yeah, it is pretty clear that they have very little time to try to turn this narrative around. And Jonathan, if you've been paying attention, as I know you have, poll after poll, this is top of the minds of American voters. It is inflation. That what comes back every single month for a matter of months. And right now, it's critically important because during election seasons, it's the spring and the summer leading into that November vote where really you start to see voters' minds harden about the policies they care about and the individuals they want to support. And Elizabeth Warren saying they need to do something on inflation. Now, if you listen a little bit more to what she had to say, she gave three things that she thinks the Democrats need to focus on. One is about price gouging and having the FTC go after companies for price gouging. Two, putting a stop on student debt, those loans. And then three, making sure that members of Congress, Jonathan, don't have the ability to trade stocks. She thinks that this is something they could deliver to the American people before November, they'd be in a better place.
I'm not sure how much that will help get inflation down, but I take your point. That's something they could do with the electorate. Number 4, Mike McKee, raise interest rates. That job is the Federal Reserve's.
That job's the Federal Reserve's, and they're not Democrats or Republicans over there. To underscore what Anne-Marie was talking about, though, you go back to 1992, not directly comparable because it was a presidential, not a midterm election year, but we were coming out of a war over oil. Oil prices were elevated, and consumer sentiment, as measured by the University of Michigan, the current sentiment number was going down into the election, and that it tells you about all you need to know. What Anne-Marie was talking about, it's the economy, stupid. It's what people think before the election about how things are going, and then look at the white line below that. That's consumer current confidence right now. That's bad news for the Democrats shaping up. Now, we'll get a lot of information on inflation this week. Some of it may be a little bit better. On Monday, we get new home sales and home prices, plus a consumer confidence number. We're going to watch not just to see if home sales are slowing, but if home prices are slowing. That would be important for inflation. If you want to argue stagflation, take a look at Wednesday. You get GDP numbers then, and on Friday we get the Fed's PCE inflation number, which is, of course, the one that they target, the 2%. Is the news going to be a bit better? Well, the forecast is yes. We talked about having a peak in inflation last month, and that may be the case. The forecast is we see inflation start to fall over the next months to almost 2% by the end of 2023. But is that soon enough for politics?
Some good news, maybe. Mike McKee, thank you. And as I've mentioned a few times already this morning, no Fed speak this week. Also, good news for many of us. I know. Mike McKee, Anne-Marie, thank you to you both. Joining us now, the wonderful, the brilliant Oksana Aronoff of JP Morgan Asset Management, who for a long time has warned about what's happening in credit, and she's been positioned for it. Oksana, you still say, though, credit risk is not repriced. You have not seen enough damage. Walk us through it.
Good morning, John. No, we certainly have not seen enough damage in credit risk. In fact, history is somewhat informative here. And if we look back, even as recent as the hike the hiking cycle the Fed went through in 2015 to 2018, a significantly more benign inflationary environment, right? Inflation got up to, oh my God, like 2%, and a higher unemployment rate than what we have today. And we saw not just credit risk go through a more dramatic repricing with high yield spreads pushing up against 500 back then, but also in terms of where the 10-year was. The terminal rate on the 10-year by the time that hiking cycle was over, was about 30 basis points higher than where we are today. So I think not even in terms of the interest rate risk pain, which has been all of the pain the bonds have tolerated so far, even that is likely not done. We do not know what quantitative easing has in store for us. We don't know how that ultimately will work out. We don't know what the path of these hikes will be. And that all will have an impact on where the 10-year will ultimately end up. So this is, this continues to be a time for caution. Certainly some things have worked. They've worked for us as well, certain shorts on, various parts of the curve, as well as on things like emerging market debt, which has repriced more significantly in light of the interest rate risk. But this is definitely not the time to be moving wholesale into credit risk.
Oksana, another thing that worked, because a lot of people piled into it, leveraged loans. There was that comfort, and I think you're discussing this. There was a comfort between taking, say, credit risk over duration risk. So people took their exposure, their credit exposure through leveraged loans over, say, high yield. Morgan Stanley, the latest actually to close out that position. Are you expecting this pain to spread just a little bit more in a way that it hasn't done year to date?
Absolutely. Absolutely, yes. So leveraged loans is the sole sector in fixed income that has been able to generate a somewhat positive return year to date because of its floating rate nature. But of course, these are junk-rated issuers. And as the cost of capital continues to come up and as they continue to need to refinance themselves in this new higher cost of capital world, that will make its way onto the fundamentals of these companies. And the default prospects should return, for high yield in general, should return to something like the historic average of slightly above 3% and not zero, which is what spreads are pricing in right now. So loans have been sort of this least dirty shirt because of their floating rate nature, but they are not going to be spared the credit risk repricing that the rest of the market will have to deal with.
A part of your playbook is to carry a higher cash load in a portfolio, Oksana. What would you be looking for through the year to deploy some of that cash?
So we don't, we have liquidity not because we love sitting on liquidity, but in this environment, in which, we came into the year with a lot of liquidity because we felt this was going to be a very volatile year, but also because we know that that's the part of our portfolio that will reset the fastest, right? So we are essentially right now positioned with, virtually no interest rate risk. We're clipping a coupon where we can to offer, the best yield that we can in a safe manner in this environment. But then it's all about that optionality longer down the road, right? It's all about the ability to take advantage of that opportunity when it does arise. Because remember, and we talk about this every time, John, the liquidity providers are moving away from this market, right? The sell side has continued to do that for quite a number of years because of the sort of de-risking that they've gone through. But also the biggest liquidity provider, the Fed, is now removing its accommodation. And that really is a game changer. So yes, we continue to have a lot of dry powder in the portfolio, north of 60%, but that's what's allowed us to generate a positive return over the last year, that and a number of conservative plays in this market and high quality floating rate plays. And so we're now ready for the next chapter to this saga, so to speak. We're ready to take advantage of that opportunity when it opens up, which we believe it will for the end of the year.
Well, I'm looking forward to catching up with you when that time comes. And before that too, Oksana, thank you. As always, Oksana Aronoff there of JP Morgan Asset Management. That's the credit story. Here's the equity one. We're down 0.8% on the S&P. On the Nasdaq, we're down about 0.5%. This week is a huge week for big tech. Up next, your trading diary and the guide through the week into the weekend. From New York, this is Bloomberg. 25 minutes into the session, some real risk aversion out there. 4-day losing streak on the S&P 500, down around about 1 full percentage point. A bit into the bond market. Treasury yields lower by 12 basis points on a 10-year, a break of 280. On the Nasdaq 100, down 0.5%. On the Nasdaq 100, aggressively lower through the month so far, down about 10 percentage points. This is the stock to watch. Can we close a deal today between the board at Twitter and Elon Musk? We trade at 50.78. The offer price 54.20. It's about $4 of doubt still in that market right there. We'll talk about that through the day. That's the price action. Here's the trading diary. China's health authority holding a COVID briefing. That comes up at the top of the hour. Huge week of earnings with Microsoft and Alphabet Tuesday, Facebook on Wednesday. Then it's Apple, Amazon and Twitter on Thursday. A Bank of Japan rate decision and another round of initial jobless claims. And Q1 GDP to close out the week. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, April 25th. Here are the top market stories we are following for you at this hour. Twitter talks. The social media company is reportedly on track to reach a $43 billion deal with Elon Musk as soon as today. The shares jump. China concerns, fears of a lockdown in Beijing fuel growth jitters that ripple across markets. Stocks and commodities sink while bonds catch a haven bid. And seeking a weaker Russia. U.S. Defense Secretary Lloyd Austin says America wants to see Russian forces ground down after visiting Kyiv with Secretary of State Antony Blinken. They pledge another $700 million in aid for Ukraine and its allies. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off and Guy is back. Welcome to Bloomberg Markets. And Guy, it's not the prettiest start to this week, but it also wasn't a very pretty end to last week either.
And I think that's the point. So the narrative today, Kaylee, seems to be we can blame China for the sell-off that we're seeing. As you said, it just adds to the growth jitters that are out there, and that has been building. But I would say back end of last week, and I was only reading about this remotely, it felt like more of a Fed story, a Fed fear that the Fed was going to raise rates aggressively and we needed to price even more. And you take a look at the S&P chart, 2 days, Thursday, Friday, straight down. This morning, yeah, you get a gap lower, but it's basically just a continuation of a theme. I don't know, what do you think, Kaylee? You were here Thursday, Friday. From afar, that looked like pretty aggressive selling, and it was nothing to do with China.
No, it wasn't. It was much more driven by expectations of a more aggressive Federal Reserve, the idea that they were going to be tightening even more rapidly and to a larger scale than the market previously anticipated. That all comes down to inflation, Guy, and I wonder if these things are actually mutually exclusive, because in addition to the growth fear around China that lockdowns could cause a lot of supply chain issues as well, and that feeds right back into that inflationary narrative.
So let's go to our question of the day, which kind of tries to address this. Our question of the day, how do you price in a Beijing lockdown? It's interesting, the Beijing Health Authority, we understand, is going to be holding a briefing very shortly to give us an idea of what is happening. We understand another district is going to be going for mass testing. It is a big threat. The question is it an inflationary threat or is it a growth threat? Catherine Rooney Vera, Baltic Capital Markets Chief Investment Officer, joining us to talk about that. To join us. Clearly haven't been here for a week. Damien Sasser, Chief Emerging Market Credit Strategist for Bloomberg Intelligence here as well. Damien, let me just come to you first of all and just talk a little bit about this. Then we'll get Catherine's take on this. Beijing lockdown, Shanghai lockdown, lockdowns across China. Is this a inflationary threat that we should worry about, or is this a growth threat that we should worry about?
Well, it's a bit of both, Guy, but I think really at the end of the day, what you have to look at is mobility data. You have to look at Baidu. Peak traffic in Shanghai, for example, is running at 40% below what it should be on a year-over-year basis. And if you look at Verified, if you look at data out of Shanghai's 2 largest airports, it's running at just 10% of capacity. So you really have to kind of dig into the data because, quite frankly, we're going to get some PMI data this week that's going to be abysmal, but it's not really going to tell you too much about what growth is going to do in China going forward, or certainly where inflation expectations are. I mean, we're looking at growth right now. I think the Nomura had GDP growth in China down something on the order of 3.9% year over year for full year 2022. I think we're a bit higher than that at 4.25%, but that's well below Beijing's 5.5% GDP growth target.
All right, Catherine, so to bring you in here, how do you view this, considering that there is a narrative out there that this is just going to mean easier policy, more stimulative measures coming from Beijing? Is that enough to support the Chinese markets?
I think if we're in Chinese equities, we have to be aware that they're going to go lower before they go higher. So I've been recommending consumer discretionary in the Chinese space for some time now. I think there's a threat to that now, given the irrational and illogical policy of zero COVID tolerance. So that to me says that we're going to get a lot of both, in terms of a hit to both inflation to the upside and to growth to this downside, not just in China, Kaylee, but we're talking at a global level here. So if we were thinking stagflation was a scenario, it should be our base case now. It was our base case in Baltic research going into this year, and it is firmly entrenched now. I think we have to be increasingly cautious on the turn in the economic cycle. A recession is part of the economic cycle. It is inevitable. It's, infamously difficult to predict, but it is coming. So let's position for those sectors that we know historically outperform at this point of the economic cycle.
So you are definitely not, by the sounds of things, Catherine, in the we can achieve a soft landing here from the Fed camp. If that is the case, and you've laid out your case pretty strongly that it isn't, where do I want to be? Sort of give me some specific areas. Lay it out for us.
Absolutely. So the top performers in terms of S&P 500 sectors in stagflationary periods are energy, are staples, are utilities, and healthcare. So those are quantifiably the best performers in a stagflationary scenario. They're also very nice because they're defensive in the event of a recessionary period. It's going to be an enormous Paul for the Fed to nail this smooth landing in this very difficult economically decelerating period of high inflation where the Fed has to both engage in decreasing its $9 trillion balance sheet, jack up rates with the market is finally pricing in the enormity of the task that the Fed has really entrenched itself in. So the Fed itself has engendered a lot of these inflationary pressures. Mm-hmm. They've far extended their expiration date in terms of policy accommodation, and now they have to play a huge game of catch-up. So 50 basis points is already baked in. 75 is a possibility. We're going to get several 50 basis point hikes. The market is already starting to price it in, finally good. But the Fed is at the end of the day taking inflation seriously, and it has been very long in the tooth in coming.
So, Damien, what Catherine is describing is a Federal Reserve that is tightening, and aggressively so. At the same time, the PBOC in China isn't tightening. There's conversation about policy getting easier. We saw that FX reserve ratio cut of about a percentage point earlier today. Right. Does that move the needle, and what else would you expect?
No, we expect more policy tightening. Policy easing ahead. We're expecting another 75 bips of RRR cuts before the end of this year, another 30 bips on the medium-term lending finance facility. I think what you have to, I think Catherine makes a great point. This transition from inflation fears to growth fears is something we've been calling for a long time, and it's going to be messy and it's going to be volatile. But just hear me out on this. I mean, eventually the world will come to the realization that we're going into a slow growth period, and that's usually good for bonds. And I know, that the 10-year and the 30-year, they're going to test these, levels, maybe 3%, whatever the case may be, but I do believe that there's some value that you can finally find by carrying in the long end of the U.S. Treasury yield curve, and by default, that means Japanese yen, which has really taken it on the chin in the last few weeks. Hammered. I mean, you're going to see a little bit of a rebound. I think one of the big things that's been overlooked throughout all this is the reason you're seeing the yuan depreciate to the extent it has is because the yen has depreciated to the extent it has. What that does is it makes Japanese exports more attractive relative to China and Korea, and I think China sees this. I think they're waking up to this reality. Yeah. I'm not calling for a 7 handle on dollar yuan anytime soon, but we've been there before and we can see it happen again.
Catherine, how are you thinking about a significantly stronger dollar and a dollar that stays up for a while?
I think it presents opportunities. I certainly agree with Damien in the fixed income space, even in the equities space. I mean, we can look at Chinese equities. I think they are going to go lower. They've gotten a hammering year to date. But I would be looking at opportunities to enter there because effectively China does have the ability to go for big fiscal stimulus, big monetary stimulus at the drop of a hat. So I do like China consumer discretionary, but I think we have room to go lower there. Within the dollar spectrum, of course, the dollar is going to be stronger before it gets structurally weaker, which is my base case over the medium term, over several years to come. But we have the combination of a massive interest rate differential between the Fed that is already massively behind the curve and an ECB that's massively behind the curve. But the interest rate differential favors the dollar, so does safe haven. So certainly we're going to get upside pressure and continue to see so from now through year end on the dollar before we see any weakness going forward. So this year I am bullish on the dollar. I do think there's opportunities in select emerging market currencies, specifically in Colombian peso and Brazilian real. They have done well year to date. That was our view coming into the year. I do see opportunities in the fixed income space, long duration, on quasi-sovereigns attached to the oil sector in both of these countries.
All right, Catherine, I have the benefit of sitting here on set in New York with Damien Sassower, so I can see his facial expressions as he listens to you, some eyebrow movements. Damien, your reaction to what we just heard from Catherine, please.
Well, I think Catherine makes a good point. Look, I mean, I'm not an equity guy. I'm a fixed income guy, but I'll talk about Chinese equities here. If you just look at margin levels, I mean, they've come down pretty significantly. If you look at turnover, it's the same thing. So if you look at technicals, yeah, you could make the argument that very light positioning in China, and the technicals are turning more favorable. And anytime this kind of happens, you tend to see a dip form. You tend to see a rebound in Chinese equities. But fundamentally, I just can't go near them. I mean, with all of the overhang going on, the fact that, China has not taken a position really on Putin's war in Ukraine, the fact that, the ADR listings here in the U.S. are going to come under pressure, and many of them are going to have to delist. I mean, there's just a lot of risk there. So, I'd stay away from Chinese equities. I agree with Catherine on all of that. But I do believe, that there is some value in perhaps starting to, kind of ease in to, dollar dollar-denominated emerging market debt, which is off something on the order of 13, 14% this year. I mean, it's just a huge, huge number. A lot of it driven by the high yield space. A lot of it driven by China property issuers. A lot of it driven by, those bonds out along the frontier. I'm talking Ghana, Pakistan, Sri Lanka, which just announced default today. So, a lot of this is going to run its way through, but it's setting up for a bit of a rebound here, especially if U.S. yields start to normalize.
Catherine, your thoughts on that?
Well, that makes a market, right? You have the buyers and the sellers. So I think that's fantastic. So yeah, I do think structurally over the long term, I would be starting to accumulate. So certainly there's different viewpoints. I think that consumer discretionary in China has a long upside potential for a sustained period of time. So if you don't have any, I think that we can start accumulating. Of course, this is not for everyone. I mean, this is for guys and gals that are looking for alpha, that are, risk tolerant, and are looking to engage in something that can give them more sustained upside than, 2.7% in treasuries or S&P 500. That's very close to where I'm seeing levels.
Are you looking at a Bloomberg terminal, Catherine?
Yes, Bloomberg all the way. Bloomberg all the way. So yeah, I think that we have to be looking for opportunities in more juicy markets than the developed ones, where I think that we're going to see limited upside from now through year end.
Do you see limited upside as well for technology stocks, Catherine? And this comes back to the story in China, especially those that are hardware focused. Supply chain issues and production capacity in Asia, a big issue.
Absolutely. I couldn't agree more. And that's where I started the conversation, talking about how both, inflation and growth are going to be adversely impacted by, this zero COVID policy in China, which means lockdowns in Beijing. So that's going to exacerbate the supply chain disruptions that we've seen add to the inflationary story. So this isn't just Putin, right? This isn't just oil prices. This isn't even just supply chain distortions. This is monetary, fiscal. There are so many impulses to inflation. So what are the sectors that do the worst in this type of environment, a stagflationary/recessionary environment? Those are consumer discretionary, and that's tech. So I think we need to readjust the portfolios and realize that we are at that point in the economic cycle where we need to change from cyclicals to value and from growth to defensive.
Damien, one final quick question to you. The Fed looks like it potentially is behind the curve. I'm wondering about the Chinese authorities. They seem to be very slow to move, and I'm wondering why you think that is right now.
Well, look, I've just been running the numbers on their money supply, on their reserve data. Things are coming in, Guy. I mean, this is going to be 4 years in a row where you've seen reserves to M2 in China declining. Now, look, China has a lot of reserves, I think 3.1 trillion to be exact. So, they've got plenty of cushion to protect against any drawdown on the yuan. But for me, I think the fundamentals are starting to roll over. And look, there's $90 billion of property debt that needs to be paid back to external creditors between now and year end. So it's a lot of money. They need to kind of make things a little bit easier, I think, for a lot of those private property developers to repay their creditors. If they don't, there's going to be a slew of defaults, and you're going to see more pain ahead.
All right, a lively conversation to start the week. Thank you so much to Damien Sassower of Bloomberg Intelligence and Catherine Rivera, Baltic Capital Markets Chief Investment Strategist. Now, coming up, we turn to Elon Musk. He is in the final stage of negotiations to buy Twitter for $43 billion. We'll have the latest on that next. This is Bloomberg.
Season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
It could be one of the biggest internet acquisitions ever. Bloomberg has learned that Twitter is in the final stretch of negotiations about that $43 billion sale to Elon Musk. Joining us now from San Francisco is Bloomberg's Ed Ledlow. So Ed, we understand from the reporting we've seen 54.20 is still the price tag. That remains the same. What is different today that wasn't true just days ago when it didn't seem like Twitter was taking it that seriously?
Yeah, it's interesting. Sources say that essentially after Musk disclosed that he had the committed financing, at least on the debt side, right? You have Morgan Stanley, Bank of America, Barclays, MUFG, committing to $25.5 billion of debt financing alongside other banks. And once that was put in place, apparently, according to sources, Twitter's board's confidence around this actually happening changed. I mean, the other piece of really interesting reporting is that sources tell us Musk continues to vet potential equity partners, right? The other $21 billion slice of this pie, which raises a lot of questions. Who does he do this with? How much cash does he front himself? And what does the final configuration of the deal look like?
Stock's still not at 54, Ed. It's at 50, spot 57. Why?
Right. Yeah, it's interesting. I mean, there are some out there that consider this a lowball offer, right? If you go back to April through August of last year, Twitter traded nearer to $70, $75 a share. And when Elon Musk was tweeting over the course of the last 2 weeks that the board had a fiduciary duty to take his offer, which was $54.20 a share and a current premium to where the stock traded. The other side of that argument was, well, hold on, the board also has a fiduciary duty to get the best possible outcome for shareholders, which in many people's opinion was a higher offer price.
Well, Ed, to that point, could we see them shopping themselves out essentially and potentially a higher price coming from someone else?
It's interesting. Two things on that point. Elon Musk has reiterated, according to sources and reporting by the Wall Street Journal, that $54.20 a share is the final offer. He's kind of maintained that line all along. Take it or leave it at this point. It is interesting to see what the specific terms of the deal would be. Because as always with a deal guy, sources are telling us this could be protracted, but it could also fall apart altogether.
Okay, so that's probably why the merger arbitrage kind of story has it at 50 still.
Exactly.
I don't. So there was this idea that this was something that other people might bid on. Ed, nobody else is bidding on it. Do you think the board was waiting for a white knight, somebody else to step in? That hasn't appeared, and as a result of which, to your point, the argument kind of flips. The fiduciary duty is to get the best value for the business.
Well, that's certainly the argument of some sell-side analysts, including Dan Ives of Wedbush, who made that exact point on the Open about half an hour ago. No one came along. I think what was interesting and why we want to know who Musk is vetting and who he'll ultimately partner with on the equity side of the deal, $21 billion of the deal, is that some of the names, for example, Apollo at the time, sources told us that Apollo could come in and combine with Musk's bid. But they could also, according to sources, have gone straight to Twitter and acted in their defense to ward off Musk's bid. So is private equity still playing a role here? Or, as has been reported, does Musk go to other high net worth individuals, family offices, like-minded people, and say, hey, get in on this bid if you believe in the changes I want to institute at Twitter?
Busy morning, Ed. Sun's only just coming up. It's going to be a long day. It could be an interesting day, though. Ed Ludlow in San Francisco. Thank you very much indeed. Right, coming up, the U.S. Secretary of State and Defense Secretary going to Ukraine for a late-night meeting with President Zelensky. We're going to give you the highlights of that high-level meeting and what it means in terms of policy and action on the ground. That's next. This is Bloomberg.
This is Bloomberg.
In terms of Russia's war aims, Russia has already failed, and Ukraine has already succeeded, because the principal aim that President Putin brought to this, in his own words, was to fully subsume Ukraine back into Russia, to take away its sovereignty and independence. And that has not happened, and clearly will not happen.
Tony Blinken, U.S. Secretary of State, visiting this weekend Ukraine's President Zelensky. Did so last night in Kiev. Joining us now, Bloomberg's Anne-Marie Hordern in Washington. Anne-Marie, the Defense Secretary was there as well. We're going to see a returning of diplomats, and we're going to see more weapons. What are the implications of this trip?
Well, first off, it was symbolic in the sense that we have not had U.S. officials, especially this level, go to Ukraine, return to the capital in Kiev, meet face-to-face with President Volodymyr Zelensky since the start of that war. We've had other officials of allies in Europe, but not the United States. So this was very symbolic and meaningful, as President Zelensky said. But then he said it was fruitful. And then, Guy, you really mentioned two of the big takeaways. One, that the U.S. is going to be working on bringing back their embassy to the capital, and we're going to have U.S. diplomats coming back into Ukraine starting next week. And then the second piece of that is, of course, more financing and funding, military funding to 15 countries, earmarked. A lot of that money will go to Kiev, as well as $165 million worth of ammunition. And this is really as the fight moves and is so strategically in eastern Ukraine. And this is where it's going to get difficult for Ukraine, because the geography is going to be able to try to contain Russia and push them back. But also for Russia, it's going to be much more easier for them to try to maintain that stronghold, because geographically it's obviously a much smaller space.
So Anne-Marie, talk to us about where else that aid is going, because it's not just Ukraine, as you mentioned, it's a number of other countries. What are they and why?
Yeah, there's a lot of aid that's been given to a number of countries, especially Eastern European countries, that are, trying to help with the influx of humanitarian aid, but also countries that have been moving military aid into Ukraine that also now need to repurpose their own stockpiles. I think of places like Poland and Slovakia, which have moved some of their older Soviet-era military weapons and machinery into Ukraine, and potentially they need to now up their own. There is also one takeaway, I would say, from this meeting that really struck me, and it comes from Lloyd Austin. He said, we want to see Russia weaken to the degree that it can't do the kinds of things that it has done in invading Ukraine. Russia weakened to the degree. I think this is a nuance in almost how the United States see this. This is potentially no longer just about Ukraine, but weakening Russia as well.
Anne-Marie, could you ever see a situation where, like Boris Johnson, Joe Biden goes to Ukraine?
I could see a situation like that if potentially it was maybe months down the line and fighting was starting to quell a bit. You saw just maybe in smaller areas and there wasn't as much of a potential threat, the way there still is potential threat in Kiev. I mean, if you look across and look at the Twitter posting of official Ukrainians, there is overnight, across the entire country this weekend, there were sirens to make sure people can take shelter. They're not going to send a U.S. president into a war zone where there's no U.S. military base when you have sirens going off for potential missile attacks or bomb threats.
Yeah.
But potentially this is something down the line, but that's a question, Guy, for the Secret Service.
Yeah, the Secret Service probably not eager to sign off on this one just yet. Thank you so much to Bloomberg's Anne-Marie Hordern down in Washington for us. Coming up, we'll turn away from politics, back to the markets and tech in particular. We'll talk about Twitter with one of the pioneers of the venture capital industry, Primetime Partners co-founder Alan Patricof. That's next. This is Bloomberg. We're an hour into the U.S. trading session. Bloomberg's Ritika Gupta is tracking the moves. Ritika, not the best start to the trading week, but at least we're off the lows.
We're off the lows, Kaylee, but as you said, not a great start because we do resume that sell-off that we had on U.S. equities that we had on Friday. But this is a global story. So take a look at the MSCI World Index. That getting hit hard or even harder. And this, of course, that China sentiment feeding through the story. Will it weigh on the demand for commodities? You see oil trading below $100 a barrel. Investors flocking to havens, so that Treasury yield down some 11 basis points. But let's stick on that demand story because it is affecting those commodities in a big way. You're seeing iron ore, aluminum down to the tune of 4 to 5% right now. And of course, unsurprisingly, when you see some of those risky assets trading lower, Bitcoin moving in tandem. Let's flip up the board and go back to the NASDAQ though, because this is actually heading for its worst month going back to 2008. That is, of course, the height of the Lehman Brothers collapse. So those lower yields today not helping it out. In fact, in this month, you've only got about 18 of the stocks within the NASDAQ that are moving higher. And we do have a host of tech earnings on deck this week. Will they be able to improve investors wrong? As we have seen, Kaylee, this shift from growth to value. Kaylee.
Yeah, we have seen a lot of destruction in technology. At the very least, though, we are actually now positive on the day on the NASDAQ 100, maybe helped out by the fact that yields are moving lower. Thank you so much to Bloomberg's Ritika Gupta. Now, Bloomberg has also learned, speaking of technology, that Twitter is on track to reach a deal with Elon Musk on that $43 billion takeover. It could happen as soon as today. Joining us now to discuss is one of the pioneers of the venture capital industry, Alan Patricof. He is also co-founder of Primetime Partners. He is here with me in the New York studio. Alan, great to see you. What is your take on this Elon Musk Twitter saga? What if he actually succeeds in buying it?
Well, it's just another example of this, what I consider this competitiveness problem that's going on in the whole world now with Facebook and Google and Apple. Now we're going to have another major company controlled by an individual, and it bothers me, frankly. Whatever the price is and whether it gets done or not done, the idea of him having this kind of control over a major media outlet, it should be everybody's concern. I mean, it may be a free form afterwards. I mean, who knows? He may just open it up and without any rules or restrictions, and you don't know what's going to come across that as a media.
Alan, there were some that were suggesting that another large tech company could step in and be the white knight here. That hasn't happened, and I'm assuming the reason that hasn't happened is that I'm talking about sort of an Alphabet or a Microsoft, the ability to get through regulators would have been virtually impossible. And I'm wondering whether we are actually starting to see a meaningful impact now of regulatory pushback, and this could be a case in point. They haven't stepped in. And the reason they haven't stepped in is they know that M&A is now virtually impossible. Large-scale M&A is now virtually impossible in their businesses. Is that a silver lining here in your view?
Well, I don't know if you call it a silver lining. I'm 100% agreement with you there. I think it'd be almost impossible to have one of the major, the FANGs, or let's even add Microsoft to it, the top 6 or 7. We should be very concerned with concentration in this company. I've been concerned for a long time, even though I'm a beneficiary of them buying some of our smaller companies. But we are just in a, when you have Google with 90% of the search volume, and when you have Amazon with a high percentage they've got of retail trade, I can't, and now, of course, there's David Ciciline's committee in the House, and there's Amy Klobuchar and Grassley, who've just come out with their Senate proposal. You've had the European proposal come out a week ago. I think it's called the Digital Media or Digital Marketing Act, which are all addressing that issue. And I would think it would be almost suicidal for a major company to try to buy Twitter at this moment in time. And I certainly would be very unhappy if it even considered to be happening.
Are we getting to the point, Alan, where these tech companies are too big to fail, in a sense?
I don't know about too big to fail. I think they're too big. I mean, I think we have too much concentration. And if you carry it reducto ad absurdum in 5 or 10 years or less, you're just going to be totally control everything. I'm sure Google knows you and I are sitting here talking right now.
I'm sure it does.
They probably even know what we're saying. And I think it goes for a lot of other things. The data is critical, and this data is controlled by these limited numbers of companies. And at the same time, it thwarts the opportunities for single companies, young companies. I see you have my book on the screen, my new book, which is coming out next week. It doesn't stifle. I mean, look, lots of small companies love to be bought by the bigger companies, but I think we're better off as a society to see them grow and nurture. And, you know, what if Apple had sold out in the 3rd or 4th year, which I'm sure it could have sold many, many times, and a lot of the others, but they stood against the wind, and we now have built major companies. And I'm not against big companies. I'm just a bit against concentration, and I think I'm not in favor of necessarily breaking these companies up, but I think we have to have some restrictions on what they do. And look, the major competitive laws, the major monopoly laws were passed in 1890 and 1913, and they didn't even know what the internet was.
Because it's a very different world.
Yeah, and I think we need new regulations to figure out how to deal with these companies.
Alan, is the book available on Amazon?
Thank you for asking. It's available for pre-order on Amazon. It has been for a month. I gather it's trending well, but it's
I guess my point is there aren't many other options, and the world that we live in at the moment is one that is dominated by these companies. So my question is, as we go through into this next sort of phase of higher inflation, as we're in this new phase of higher inflation, of higher yields, what do you think of these companies' business models? Because they've largely been built in a time of globalization, low interest rates. Their stock prices have benefited from those low interest rates. As we enter a new period, do you think that these companies are built for that new period? Do you think they are able to thrive in the same way that they have done in the past in a world of slower growth, higher inflation, higher interest rates?
Honestly, I don't think that inflation and interest rates are the factors. I think the focus for most of these companies is advertising. If advertising slows down, and there seems to be indications that that's happening, I think Snapchat made some comment about that recently, we're going to see a decline in, certainly the Facebooks and the Googles and Amazon. And people forget, I forget the exact number. Amazon is now an advertising behemoth. And so they're all going to be affected by that, not Apple.
Well, you talk about advertising. That's where Netflix is turning to as potentially a way to keep growing now that its subscriber base seems that it's just not going to grow. In fact, it's actually shrinking to some extent. Is there a lesson to be learned more broadly from what we saw from Netflix last week, the idea that maybe the peak is behind us already?
Well, you saw CNN Plus ending. There is an enormous proliferation. You and I both know what we did last night and how we searched, and it's overwhelming to figure out what you're going to watch, and I think Netflix is in that struggle, but I think they'll figure it out. And there's advertising right now. I forget, I was watching, maybe it's Hulu. There's advertising on several of the streaming channels already, so you'll be able to get it with and without, just like a lot of other services you can get. I guess, I don't know if you get Audible with and without. I know a lot of podcasts will give you a subscription service without advertising or with advertising, and you don't pay less or nothing.
Yeah.
Yep, you can get your Kindle with or without advertising on Amazon as well. I'm sorry to jump around, Alan, but time is short, and your views are really interesting. What do you think about Chinese tech? What do you think about the supply chain problems that things like lockdowns of Beijing and Shanghai are causing? What impact do you think that's going to have on Chinese tech? What do you think that's going to have on U.S. tech?
It's got to have a big impact. I got an email over the weekend from a young man who worked for me when he was getting out of Columbia Business School about 10 or 15 years ago. When he wrote me a long email about what it's like to be living in China married with a young kid, and how he has not left his apartment in a month, and how every food has to be delivered to the door. it has a tremendous impact. The factories have got to be slowed down dramatically. Supply chain is not going to change overnight, and China is going through a very, very difficult period. And as an American, or let's say a non-Chinese, you've got to be concerned about investing in an area where you just don't know what the regulations will be tomorrow, and what the economy is going to do. I mean, they've slowed down for the first time in decades.
Well, on the subject of what tech you do and don't invest in, often when I ask questions about technology on this show and others, people tell me you need to differentiate between profitless tech and those that are quality growers, have the cash flow, etc. There's a line to be drawn there. I know your book takes a look at your career in venture capital. I would love to just get your take on how you differentiate between companies that are worthy of investing in the technology space and those that maybe are not.
Well, you have to understand, I invest 100% in private companies. And I would say, since a lot of them are very early stage, I would say, I don't want to give a percentage, but it could be 80 or 90% don't make money. And they're all equity financed. That's why I say inflation and interest rates don't have much effect when you're equity based. And I think that I don't see any cessation of investing in these young companies. We are in an entrepreneurial society, a risk-taking society. It's permeating all over the world today. For the first time, I remember 10 years ago trying to get my firm to invest in Africa. Now, African investments are interesting, and there's a whole startup community all over the world. India, of course, is a big startup area. So I think that lack of earnings is not going to affect it. Now, when you go to the public markets, I honestly can't give you an opinion except to say that I've always followed the policy that companies can't sustain themselves ultimately in just shareholder continued investments, whether it's secondaries, follow-on rounds. At some point, people say we're the emperor's new clothes, and they want to see some kind of net free cash flow ultimately. But we've been living in a economic environment, stock market environment for years that has forgotten about that. And PE, I remember I was brought up on PE ratios. If we go back to value,
you mean fundamentals?
Yeah, if we go back to value investing, we're going to be talking about PE again, and not price times EBITDA or price times revenues. And it gets down to, ultimately, there should be some return. Now, you know, I'm not going to, there's no need to name the companies, but there are still some of our major tech companies that are been started up in the last 10 years, 15 years that still lose money. And investors are still giving them high valuations. And what happens at one point or another is you have an air pocket, just like if you're, God forbid, on a plane and it drops 10,000 feet. It doesn't go down a little bit at a time. It drops. And, you know, we could see that happen if people finally say, you know, we're the emperor's clothes. I'm, you know, tired of supporting these companies that don't show profits and don't improve their bottom line.
All right, we have to leave it there, but great to get your perspective. That's Alan Patricof, who, of course, is Primetime Partners co-founder and the author of No Red Lights. Now, coming up, a new survey warns that economic conditions are getting worse for small businesses. We talk with Joe Wall, Goldman Sachs National Director of the 10,000 Small Businesses Voices. Next, this is Bloomberg. Small business owners say it's getting rough out there. A new survey from Goldman Sachs found that inflation, supply chain issues, and workforce challenges are having a negative impact on small businesses. Joining us now, Joe Wall, Goldman Sachs National Director of 10,000 Small Businesses Voices. Joe, great to speak with you. 91% of small business owners say broader economic trends are having a negative impact on their business. That is the vast majority. Which issue, inflation, labor, is the greatest for them?
Yeah, well, Kayleigh, thank you for having me on this morning. Great to be with you. So, just to step back a little bit, we've done now 12 surveys dating back over the last 2 years of our small business community. We started at the beginning of the pandemic and have seen sort of the roller coaster that has occurred over the last 2 years. Our most recent survey in January, acutely spotted that inflation, supply chain issues, and workforce challenges were obviously weighing on small business owners to a significant degree. Our survey, that we're releasing this morning asked the question, compared with January, have things gotten better, worse, or are they the same? What we found on inflation is that 88% of small business owners say inflationary pressures on their business has intensified. What we found on workforce is 88% say it's either worse or the same, and on supply chain, 80% say it's worse or the same. So, the cumulative impact of that has really painted a picture that, that's indicating that the economic conditions for the small business community have gone from bad to worse just in the last 3 months. And I would add in, the new variable is that energy prices are having also a real negative implication for business owners across all industries. We found that we sorted it by sector. There wasn't really a discrepancy from the construction industry to, more retail industries or even services. So, we often lose sight of the fact that those energy prices also just weigh on employees, right, who are just trying to commute to work and perhaps picking up their kids from school.
So, Joe, you've titled, therefore, the new report from bad to worse. My question to you is, how do we go from worse to bad? i.e., how do we start to turn some of these things around?
Well, some of the more, macroeconomic conditions are obviously, complicated to say the least. And, obviously the Federal Reserve is very mindfully watching them and, indicated based on, their commentary last week that they're likely to, raise rates again in May. Supply chain issues, I think one thing that the small business community feels like they have, it can be a significant resource is, creating a more durable domestic supply chain, which I think is something that over time, we've lost sight of. And, that has become quite apparent not only with the war in Ukraine, but also obviously, a growing, complicated relationship with China. So as we think about sort of the modern supply chains that fuel the U.S., I think small business owners feel like they want to, have a key role to play in ensuring that we have durable supplies.
Okay, Joe, so we've talked a lot about how the costs that these businesses are facing are going up on the labor supply, the supply side, on the energy side as well. What are they telling you about their success in passing those costs on and just raising prices to offset that?
Well, for a lot of them, I think what we saw this survey is that the inflationary dynamics are obviously having a significant impact on labor-related issues. So 2/3 of businesses say that they have raised wages to hold on to their employees. About 60% have raised wages to recruit new employees. And also about 60%, 2/3 say that they've had to raise their prices as a result of the inflation dynamics right now. So obviously the tail impact of inflation, is being felt not only across the labor side of small businesses, but also when it comes to, the cost of goods and services.
Is this a global phenomenon? How does the U.S. compare with, say, Europe?
Well, our survey sample was just the U.S., so I can't speak for, our small business owners in London, Paris. But I would say it's quite clear just based on the economic conditions around the world that these data points are probably not dissimilar to what you're seeing in Europe.
So obviously we're talking about existing businesses here, but in the environment that you're describing, Joe, especially one in which the Fed is tightening and borrowing costs are going to go higher, what does that mean for new business formation?
Well, just from a capital perspective, with interest rates going up, that's only going to make, the access to capital a more, significant challenge for small business owners. And that's obviously something that, we readily see in our data as well. The reality is for most existing small business owners on the capital side is that because of their financial statements from 2020 and 2021, they obviously are having a difficult time seeking traditional financing. And so for a lot of them, they're still relying on the COVID era, loan programs that for a lot of them were really a godsend in terms of making sure that they had access to flexible and dynamic capital that they could deploy, whether it was to pivot their business or to, just simply keep, their business up and running during, what has been a very, a very dynamic and totally unpredictable climate over the last 2 years.
In terms of how this new environment is going to shape policy going forward, how should the government be thinking? As you say, they're relying on COVID-era policy to deal with the new environment that they're facing. What does government need to do? How does policy need to be tailored, do you think, to better suit the new environment versus the COVID-era environment, which I know we're talking about it still with relation to China, but it feels like a distant memory in some ways relative to the experience we're having now?
Sure. Well, in the U.S., believe it or not, the Small Business Administration has not been reauthorized by Congress in over 22 years. It was 2000 was the last time that Congress reauthorized, and by reauthorizing, in layman's terms, Congress usually every few years looks at government agencies and re-examines the programs, sees if they're working or not, sees if there's new programs that they could perhaps incorporate to sort of, to catch up to the, the modern small business. So in 22 years, that has not been looked at. So our, chief objective this year is to really build momentum for Congress to reauthorize the SBA and really tailor programs that meet the needs of today's small business, not the small businesses from 22 years ago.
Joe, it's great to catch up. It's fantastic the work you do. It's really interesting to get the insight as to what is happening in this community. Joe Wool, Goldman Sachs National Director of the 10,000 Small Businesses Voices. Thank you very much indeed. This is Bloomberg. So not much of a Macron bounce here in Europe today. The Stoxx 600 down by 1.6%. The CAC underperforming. Euro dollar earlier with a 106 handle. We've got a 107 handle, but we're down pretty hard. The French 10-year catching a bid. I think it's a wider story that we're watching here. But nevertheless, up next, the European close. Christine Vergère of the Institut Jacques Delors is going to be joining us to talk about that election. Monday the 25th of April, not much of a Macron bounce. European stocks sink sharply. The CAC underperforms. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
"30 minutes to close. The price action looks like this. European stocks down and down hard. We didn't get the Macron bounce, but in some ways, the election victory was priced in. We'll talk about that more in a moment. Is this the China effect that we're seeing represented across Europe? Certainly some of the Nordic markets are down even more, but the Stoxx 600 down by 1.72%. Euro dollar with a 106 handle a little earlier on. We got a 107 handle now. We're down by 0.8%. There is certainly a bid in the bond market all the way across Europe, all the way across the curves. The French 10-year, the OAT, as you can see, catching a significant bid today, but it is by no means extraordinary. These numbers pretty similar to most of the other main markets. Not much of an election effect here actually to be found in European stocks or bonds, Kayleigh?
Well, Guy, exactly. As you allude to, we're seeing the same thing with the U.S. Treasury market here in the U.S., and a lot of it comes down to that China story. We just had the headline crossing the terminal that Beijing is expanding COVID testing now to the entire city beginning tomorrow, April 26th through April 30th. So that is something that risk assets have to grapple with as they consider the growth story out of China. And that does have stocks lower on the day, though we are off of session lows. The S&P 500 right now off about a percentage point. You actually saw the NASDAQ 100 in positive territory earlier, though it then gave back some of those gains. But of course, the equity market maybe helping stem the losses a little bit is the fact that we are seeing yields moving lower, and substantially so, down 12 basis points on the 10-year Treasury yield. We are just shy of 278. At the same time, you're seeing a stronger dollar. And then, of course, the demand story out of China. What does that mean for the commodity complex? As a result, you're seeing a lot of it under pressure today, including oil. WTI now down almost 6 full percentage points, trading at $96 a barrel, Guy.
It's amazing. I thought first thing this morning we'd be talking solidly about the French election and the impact of it. In some ways, not a surprise. I think actually the surprise may come later as we think about exactly how Emmanuel Macron is going to run his second term. The French president clinching a second term as president after a historic challenge from the far-right candidate, Marine Le Pen. Okay, I was expecting to hear from the French president then, but who we shall hear from is Bloomberg's Caroline Conan. Some great coverage over the weekend into this morning. Caroline, thank you very much indeed for sticking with us to bring us what we should expect next. The French election is over. We have another one for the parliament in a few months' time. That may prove to be critical. What do we know about how different the second Emmanuel Macron term is going to be from the first?
There is short-term relief, as you can see in the markets, but clearly all eyes are now on this parliamentary election that are taking place mid-June in France. They are considered as the third round of these presidential elections, because even if Macron did win re-election last night with about 58% of the votes, he will still need to secure a parliament majority, and this might prove more difficult than last time in 2017, because his party, Republic on the Move, has actually failed to really widen their base in recent local and regional elections. So perhaps he may have to form some alliances, for example, with the Republicans, who are in disarray after their candidate Valérie Pécresse got less than 5% of the votes in the first round, or perhaps even with the Greens, who have very different views compared with Emmanuel Macron when it comes to the future of nuclear or the future of France's energy mix, for example. So he may have to build a very fragile majority, and this will determine how much he can actually govern and how much he can actually implement tough reforms.
So, Caroline, there's obviously the question of what this means for the future of France, but the future of Europe as well. How has the response been more broadly on the continent to the results of this election?
Of course, there was huge relief from European partners. We heard last night from Christine Lagarde, from Olaf Scholz, the German Chancellor, also saying, of course, this was a victory for the European project, because victory of Emmanuel Macron means continuity, stability within Europe, within also the NATO alliance, for example, because, as you know, Marine Le Pen wanted to leave the military command of NATO. There will be no such things with Emmanuel Macron, who, on the contrary, wants to increase the defense spending to 2% of GDP, which is the NATO target. So that means continuity and stability. You know, France is still presiding over the EU until the end of June. So Macron will continue to try and achieve more European integration. So there is clearly a short-term relief among European partners, because France is still considered a reliable partner.
All right, Bloomberg's Caroline Conan in Paris for us. Thank you so much. Let's get some more perspective now on the challenges ahead for Macron. We're joined now by Christine Berger, Institut Jacques Delors Vice President. Christine, your reaction, please, to a Macron victory, but one that was won by a much narrower margin than in 2017.
Yeah, well, the victory of Emmanuel Macron is let's say, better than expected, because the polls recently were indicating 55-45. He got 85%. Of course, it's less than in 2019, but still it's a good victory for him and a clear defeat for Marine Le Pen. And I think this is good news for the future of Europe, as you said, as your correspondent in Paris said, because in France, you know, the President of the Republic has very strong powers, especially in the field of European and international affairs. And whatever the result of the parliamentary elections in June is, I'm sure that Macron will be able, in any case, to continue with his European objectives.
Yep. Christine, what does this tell us, though, about the state of politics in France? Huge numbers of abstentions, and while you say it was a convincing win for Macron, which it was, nevertheless, the right wing is clearly gaining momentum, year after year, election after election.
Yeah, for sure. But now this is a problem with Macron, for Macron to try and find solutions to this malaise, which is, first of all, an institutional and democratic malaise linked partially to our institutional system, and then a social malaise. Because it's not only Marine Le Pen, it's also Jean-Luc Mélenchon, who belongs to what many people call a sort of extreme left, who was near to be in the second round of the election. So you have a great part of the electorate which is concerned mainly by economic and social aspects. And of course, the war in Ukraine in particular led to an increase of the prices, to some difficulties in the day-to-day life of many French citizens. And of course, this situation will continue. We have also the consequences of the pandemic, COVID, and Macron will have to try and find solutions both to the democratic aspects with maybe institutional reforms and the social aspects of the problem linked to an economic and social policy in the future, which may be different than in the past.
So, Christine, it's one thing to come up with solutions and reforms. It's another one to actually get those enacted. What difficulty or lack thereof do you think Emmanuel Macron will have in actually getting his agenda items through for his ideas to become real policy?
Yeah, well, probably the difficulties may come from the streets because, of course, we don't know what the result of the parliamentary elections will be. The extreme right and the extreme left will try to get more members in the parliament than in the past. But in order to get such a result, they need to have allies. And they don't have so many allies. In particular, the party of Madame Le Pen, who is rather weak on the local, in the local areas. And we could see it in the regional elections last year. Le Pen made very bad scores in the regional elections, and she doesn't have another party to be with her. Contrary to
Mélenchon says he wants to be Prime Minister, though. What possible kind of range of outcomes could we be looking at in this parliamentary election? Is it possible that we could see Emmanuel Macron producing some sort of a coalition? Is that the most likely outcome? What are the tail risks in this parliamentary election?
I think, as I say, you know, we have a very specific system for the parliamentary elections, and just not only one party can be in the opposition. Either Madame Le Pen or Mr. Mélenchon, as I said before, have to have allies in order to try and get more members, if not a majority, in the next parliament. I think it will be very difficult for them. They may get more members, but getting a majority is another thing. Although Macron will try to extend his majority, and now the question for him and his party is whether they can organize a new structure with different sensitivities in it, so that those people have members in the parliament who support the President of the Republic. And most observers think that Macron will have a majority in the next parliament. Of course, this majority may be more diverse than the previous ones, with a lot of several minor structures belonging to this majority, and I'm convinced it will be difficult for the others to get a majority to oppose to Macron, which means that conflicts may come from the street and not from the parliament.
That's interesting, interesting. Christine, thank you very much indeed. Christine Berger, Institut Jacques Delors, Vice President, thank you very much indeed. I want to come back to a headline that I think is relevant considering the market action that we've been seeing. Beijing expanding COVID testing to 12 districts in the area. It is going to be something, obviously, that we're going to have to watch very carefully because this is going to have a meaningful impact on top of the lockdowns that we're seeing elsewhere in the country. This is going to happen between the 26th and the 30th, this testing that we're going to be talking about here. It's an ongoing issue for global supply chains. Shanghai, now Beijing. Obviously, the inflationary impact and the growth impact need to be weighed very carefully. We're going to take you back to the French election next, though. Macron's re-election, taking one of the biggest risks, you could argue, for investors in Europe off the table. Or has it really? The issue in Ukraine, obviously massive. China, a huge factor for the European economy, particularly for economies like Germany. Roland Keolan, head of European Equity Strategy at SocGen, is going to join us next. He'll be talking to us about these threats. That's coming up. This is Bloomberg.
Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
So we're still looking for that Emmanuel Macron bounce in the equity market. His re-election should be a relief to investors. Yet today, we see the CAC 40 underperforming. Let's talk about what we're seeing here and try and explain that market reaction. Roland Keolan, head of European Equity Strategy at SocGen, joins us now. Roland, let's talk a little bit about why the CAC is underperforming. Is this a classic case of it's being better to travel than arrive? The market had been anticipating that we would see a Macron win. Now we've got it. We need to focus on other things.
The thing is that we had a lot of uncertainty with this election before the first round. After the second round, what we have seen is with the momentum in polls that the victory of Macron, it was clearly something that pushed investors to reprice in the market. So I would say that today the impact is pretty limited. And you know, you were mentioning the CAC 40. The thing is that when you look at this index for the French economy, for the French equities, we are talking about an index which are full of exporters, right? With luxury goods, car makers, oil and gas, pharmaceuticals. That has a heavy weight. They are global players. So to have the impact of the French election, we need to see more the domestic names.
Okay, well, let's talk about some of those big exporters you were referring to, the luxury names, for example. A lot of those exports are going to one market in particular, and that is China. How does the COVID-0 stance in China, the questions around growth there, affect the thesis, not just for French equities, but European equities more broadly?
Yeah, sure. I mean, China, what is going on in China is, I would say, affecting the European equity market by, on two ways. The first one is, let's say, directly on the demand there, right? Companies that have big business in China. Imagine you mentioned luxury goods, car makers. I mean, everything related to commodities, because it's the biggest market also for commodity suppliers. The second thing is indirect, I would say, through the supply chain. And also here we can see some disruption on the supply chain because a lot of factories are based also in China. And so that could be also another impact on the European equity. So you see two different impacts. One is direct through the business, through the sales, the revenue generated by European companies in China. And if we have lower growth, that's going to have an impact for these names. And the second one through the supply chain.
One area that we are seeing, obviously, a fair amount of movement today in Europe is in the euro. Touched 106 a little bit earlier on, Roland. Talk to us about the impact that a significantly weaker euro could have in terms of the exporters you've just referenced.
I mean, having a weaker euro, it could be seen as a good sign for exporters, right? Because you are more competitive versus your, other region, etc. However, sometimes a weaker euro is also reflecting some tension and some stress from the market on the Eurozone growth. And it's what we have seen recently. Most of the investors we are talking to are very, very pessimistic on the Eurozone, European and Eurozone growth outlook. We are not in this camp. We think that Eurozone growth could be much more resilient than what is right now pricing in the market.
Okay, and I wonder how much the earnings story can be supportive to Europe as well, Roland. Obviously, there's a growth concern in Europe. There is also an inflation one. These companies are facing higher costs. Do they have the ability, to the extent that, say, U.S. companies do, to exercise pricing power, to pass those on and retain margin?
Yeah, that's a good point. I think that's going to be a moment of truth. The first quarter of this year is going to be very important because in this period we have seen the war, we have seen the big spike in inflation in a lot of commodities, raw materials. And I think that we can have some surprise on the top line, on sales, on revenues, because when you say inflation, you mean higher prices, right? And so some company could benefit from that. But we can see also higher costs. So all the question will be on the margin side. And on that front, we think that we could see some downward revision during this quarterly season. And but again, we'll see how companies have some pricing power here. And you were mentioning, for example, sector luxury good. It's a sector where you can find some pricing power.
Do you think it's going to be, I'm curious as to what you think is going to bring investors back to Europe. Is it going to be, as Citi suggests, and Citi put out a note a little bit earlier on this saying another leg lower for Europe, and you start to get to the point where Europe looks really attractive and the sort of the play could be into European banks, for instance? Or is it, as you say, maybe actually earnings are going to be better than anticipated and people are going to be surprised there? What do you think is going to get the international community interested in Europe again?
I think we need to have a better visibility on the geopolitical situation. We have seen a lot of outflows from European equities, right? For this money to come back on the European equities, we need to have more visibility on the geopolitical situation. That's the first thing. But regarding the valuation, we are right now at historical discounts on European equity versus the US, more than 30% discount when you look at the PE ratio. And you know what? When you look sector by sector, all the sectors except healthcare in Europe are trading with a heavy discount compared to US peers. This is very, very impressive. So it means that clearly you have a value story right now on the European equity market.
All right, we'll leave it there, but thank you so much for joining us from Paris today. Roland Calouan of Société Générale, thank you so much for joining us. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. British manufacturers raise prices at the fastest pace in more than 4 decades. It's their attempt to cover soaring raw material and energy costs. And according to the Confederation of British Industry, more price hikes are on the way. Credit Suisse is considering its second board management overhaul in as many as years. CEO Thomas Gottstein is struggling to turn around the bank after a series of scandals and profit warnings. Bloomberg's learned Credit Suisse may replace long-standing executives on its management board, including its top lawyer, CFO, and the head of the Asia-Pacific region. And Barclays benefited from the volatility spurred by Russia's invasion of Ukraine. The British bank made about $644 million from the emerging markets trading in the first quarter. Amongst other bets, Barclays cashed in on the Russian and Ukrainian credit default swaps. And that is your latest Business Flash. Guy.
Ritika, thank you very much indeed. Kayleigh, I think we get numbers from Barclays Thursday. This is a fantastic scoop on the Bloomberg. What I want to know is how much risk did they take to make those kinds of returns? It's been interesting. Some of the Wall Street banks significantly higher risk-taking to generate some of the trading numbers that we saw, what was it, 10 days ago?
Yeah.
It's going to be interesting to see whether that gets replicated here in Europe.
Yeah, it's a really interesting question, Guy, because of course all of the volatility bred in large part by the conflict in Ukraine does create massive opportunities to make money, but at the same time you run the risk of a trade blowing up in your face. And of course, obviously, there's no real winners in war, but to a large extent these banks can reap some kind of reward. Ritika was talking about the money made on Russian and Ukrainian credit default swaps. They made about £100 million just on that alone.
Yeah, absolutely. You've got a currency trade. Basically, everybody had to move things around pretty quickly. And when that happens, it's going to create gaps in the market. You are obviously dealing with probably significantly wider spreads here, and that's when we come back to this risk idea. As you say, if things can go a little bit wrong, you are running significantly greater risk. But this has been the benefit that Barclays has been able to generate. It's one of the few European banks that still is going to maintain a decent trading story. There are a few others, but largely European banks have backed out of trading. You see how all the others have repositioned. Maybe it's going to continue to pay off. Trading did very well, obviously, during the pandemic.
Yeah, and it did really well on Wall Street in the first quarter. And of course, to some extent, Guy, you need it to, because deal-making activity, for the very same reasons that trading is doing well, deal-making is not. So you have to have something that kind of offsets that a little bit if you're a bank that wants to perform well.
Yeah, maybe why everybody's so interested in maybe taking part of this Twitter deal. There isn't much deal to be done right now. We're still waiting for news on that front. So here's how the European markets sit. We're heading into the close. Monday the 25th, nearly done. We'll be back with the close in just a moment. Details to follow. This is Bloomberg. Half past the hour. We're wrapping up the Monday session, and it's turned out to be a fairly ugly one for European equities. No Macron bounce here, as you can see. A sea of red. Actually, the CAC 40 is down over 2% today, one of the big underperformers. But there are others. You can look at some of the Nordic markets. They're down more aggressively. But even the FTSE 100, with the commodities down as much as they are, is down by 1.77%. The DAX is down by 1.54%. So a pretty ugly session in aggregate here in Europe. But to be honest, it's just a real continuation continuation of the price action we saw at the back end of last week. This is what the intraday chart looks like, a gap lower first thing this morning, and actually a reasonably tight range ever since then. So we've not really, I don't think, learned much from today's session. We're down by around 1.8%. Clearly there's a China factor in all of this, and you can see that represented elsewhere as well. Euro dollar trading below 107 a little earlier. We've got it at 107 now, but earlier on we had a 106 handle. We're down by 0.8%. We are seeing a big bid into the bond market, and it's pretty broad. It's not just OATs, but the French market, obviously, we've been watching very carefully for the election fallout. There hasn't really been any, and actually the bigger picture story, I think, has been dominating the macro picture more broadly, not the Macron picture, the macro picture. I'm sure there's a joke in there somewhere. So the French 10-year catching a pretty big bid. But then we come on to the commodity story, and I think this is where the real action actually is. Brent crude down by 6.5% today. Metals being pushed lower by the China story. Been breaking the news over the last half hour from that briefing in Beijing and the testing that they're going to be doing there, really hitting the commodity sector really quite hard. And you can see that represented quite clearly in the GRR, which is the global rank returns. And as you can see, what you're looking at here is the basic resources sector, the miners down pretty hard. Then there's the energy sector down by 4.6%. You've got the luxury sector. That's a China story. We're just hearing from SocGen about what's happening with the luxury sector. Insurance, banks, financial services, all lower. The only area that you're really hiding out today is in the groceries, the utilities, the food and beverage. Those are the areas that are outperforming here. The safe value areas of the market are doing better today. No real surprise given the macro backdrop that we have in all of this. There are some stocks that are benefiting though from what we're seeing in France. EDF, Électricité de France, up by 3.5% today. But there's other stories out there as well. Ubisoft, interesting, up by 10% today. Possibility of some M&A in the gaming sector, certainly lifting that stock, a potential target being talked about. And then we come to, I think, actually probably the most interesting story of the day out of the European single stocks, and that is Philips. The stock down by 11.41%. And the news is pretty grim, I have to say, Kayleigh. What we're hearing here is that inflation is going to last for really quite some time. They've got issues with certain products, certain key products, ventilators that they're having to deal with. We heard more news about that last week. They've got an ongoing sleep apnea product which is continuing to cause problems. But the broader macro picture, I think, really represented by Philips, the story basically is that cost inflation is going to be with us for a while.
Yeah, that's exactly what we heard.